Last week, we have discussed business related to trading division of investment banks. In this week, we will move on to asset management division. Asset management, or sometimes called investment management, refers to the professional management of investment funds on behalf of individuals, families, government, and institutions. Asset managers offer investment products to clients. The products can vary from traditional financial assets to alternative products. The traditional financial assets include stocks, fixed income, currency, commodities, convertibles, indexes, and derivatives. Alternative assets are less standardized investment assets, such as hedge funds, private equity funds, real estate, arts, and antiques. Most large investment banks participate in alternatives such as hedge funds and private equity funds to varying degrees. For example, JP Morgan's asset management division was the third largest hedge fund manager in year 2017, with asset under management, or AUM, of $45 billion. And Goldman Sachs' asset management arm has one of the most comprehensive private investment programs. This table highlights the top 10 asset management divisions housed within an investment bank for year 2017. The data is from Scorpio Partnership's annual private banking benchmark for 2017. We can see global investment banks are active participants in asset management. There are names of large global investment banks, including UBS, Morgan Stanley, Bank of America, Credit Suisse, Citigroup, JP Morgan, and Goldman Sachs. On the list, we also have some large regional banks, including Wells Fargo of the US, Royal Bank of Canada, and the BNP Paribas of France. The number one firm on this list is UBS, with total asset under management of more than $2.4 trillion. This number is roughly equal to the total GDP of Italy in year 2017. An asset manager is responsible for investment strategies and will decide what investments to make or avoid. The ultimate purpose is to grow a client's portfolio. For example, JP Morgan Asset Management has more than 400 investment strategies that cover equity, fixed income, and alternatives of local and global markets. Asset managers charge fees for their professional investment strategies. Asset management fees may vary with the type of assets managed. Alternative assets typically charge the highest fees, with management fees ranging from 1 to 2% of AUM. Aside from management fees, there is also performance fee ranging from 10% to 20%. For example, a manager helps you invest $5 billion and increase the value of your investment to $6 billion. If the management fee is 1% and performance fee is 10%, the manager will charge 1% multiplied by 5 plus 10% of the increased value of 1, which will add up to a total of 0.15 million. Equity and convertible investments usually charge a management fee of 0.75 to 1.75% of AUM. Performance fees may be paid. Bond and commodity investments usually charge a management fee of 0.5 to 1.5% AUM. performance fees are usually not paid. Index investments have the lowest management fees, usually with fees ranging from 0.1% to 0.5% of AUM. There is no performance fees for index products. The performance of asset managers can be measured in various ways. The easiest way to look at is absolute returns. For example, a manager obtained an annual return of 8%, but a positive return may not necessarily mean a manager is doing a good job. For example, let's say a manager obtained an annual return of 8%, but the market return is 12%. This is not good because the client would be better off simply by holding a market index. But how about, say, a manager who is able to generate a return of 20%? A client may also want to benchmark the 20% return against the amount of risk that is taken. Measures of risk-adjusted performance include Sharpe ratio, trader ratio, as well as factor model alpha. So, can asset managers really add value to clients? Perhaps you have heard of the 1 million bet of Warren Buffett in 2008. Warren Buffett posed a bet against hedge funds that a simple S&P 500 index fund would outperform a hand-picked hedge fund index over a 10-year investment horizon. And in year 2018, we knew Warren Buffett had won the bet. So, the result of the bet seems to suggest that hedge fund managers did not add value to clients during year 2008 to 2018. Empirical evidence on fund manager performance also tends to suggest it is hard to beat the market due to transaction costs and management fees. For example, a study by Carhart in 1997 suggests managers generate positive alphas before fees, but negative alphas after fees. Alpha is a measure of risk-adjusted return. Burke and Green in 2004 provided an interesting perspective into this matter. They think there are skilled managers on the market. Their skills will attract new funds until the cost of managing those extra funds drive alphas down to zero. Thus, the skill of managers will show up not in superior returns, but rather in the amount of funds under management. Okay, in this video, we have introduced the asset management business of investment banks. In our next video, we will move on to wealth management.